Hello and welcome to Portfolio Matters, weekly markets checklist, week 205. But before we get into it, Richard will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Busy week. Got lots to talk about as lots has changed in the market since we last met 2 weeks ago. A bit of housekeeping. Having been away for much of the past month, I'm now back, so we should be back to a 2 week schedule for a while. Okay, lots of news. So, most of the major central banks met. The Fed held rates at 3.5 to 3.75%. Jerome Powell stated the economy had clearly improved and unemployment stabilized. He will be more led by the data in future, implying that he's not in any hurry to cut rates. Donald Trump has nominated Kevin Warsh as his nominee for the chairman of the Fed to replace Jerome Powell, whose term runs out in May, I believe. And that because Kevin Warsh is viewed as a credible candidate to lead the Fed, that led to or precipitated a big sell-off in safe havens, gold and silver. We will show you the charts in a bit, but silver is down 30% since we last reported. The Bank of England met and it left interest rates unchanged at 3.75% in a 5-4 vote, with 4 dissenters calling for a cut. The market now places a 50% chance that the Bank of England will cut rates again next month. The ECB met and kept rates unchanged at 2.15%. Christine Lagarde has stated that interest rates were in a good place and the market expects the ECB's next move to be up. However, inflation in the Eurozone is very low. It's 1.7% as of January, and economic growth is weak at 1.3%, 1.4%. So I see little prospect of the ECB raising rates. The US announced a trade deal with India, so tariffs on Indian exports will fall to 18% from 50%. In return, India has agreed to halt purchases of Russian oil and instead will gain access to US and Venezuelan oil. OPEC Plus has agreed to pause production increases in Q1 2026. Reminder, last year it increased production by 2.9 million barrels a day and potentially is intending to increase production by a further 1.24 million barrels this year. But so far they've agreed not to proceed with those production increases. Our cover photo this week is not of Donald Trump for once. It is of the Japanese Prime Minister, Sanai Takaichi, whose gamble on a snap election appears to have paid off with a landslide supermajority. Now she's proposing to amend the constitution to strengthen defense and security policies, which involves removing the ban on weapons exports and diluting the pacifist principles enshrined in the constitution by the Americans post-World War II. She also intends to boost the economy through further fiscal stimulus, including a temporary reduction in the food tax. Astonishingly, equity, bond, and currency markets all reacted well to this. So the bond market, actually, bond yields on the Japanese 30-year fell. So sell the rumour, buy the fact, it appears. UK gilt yields sadly rose after there was speculation that Labour Prime Minister Keir Starmer would be replaced following revelations that his appointment as US Ambassador Peter Mandelson had been passing Jeffrey Epstein classified government documents. the gilt market is calming down a bit now that Keir Starmer seems to be firmly in place. So some charts related to the news. Well, another US government shutdown looms, sadly. So having avoided a shutdown 2 weeks ago, the the agreement to avoid a shutdown was predicated on them coming to a budget agreement, and that has not happened. So the market is now placing a 75% chance that there'll be a shutdown this weekend. Chaos continues in the US. Trump's nominee for the chairman of the Fed, Kevin Walsh, I thought this was amusing. So this is the history of his monetary policy stances, and it appears he blows with the political wind, which is not terribly encouraging for the stability of monetary policy in the US. And onto the economic news, where we had UK GDP numbers for Q4, and they were an anemic 0.1% quarter on quarter, year on year 1.0%. So the Labour government's plan to boost UK economic growth through higher taxes and higher bureaucracy appears to be failing. EU inflation came in soft at 1.7% year on year in January. Core was also soft at 2.2%. GDP growth was 0.3% in Q4, better than UK, 1.3% year on year. Yesterday we had US non-farm payrolls for January. They came in hot at 130,000, but the 2025 numbers were revised down by an astonishing 1.03 million to leave total job creation for 2025 at only 181,000. So, throughout the year, as we've been saying, non-farm payrolls, the birth and death model of company creation, has systematically overestimated the strength of the US labour market. Job openings fell to 6.5 million, but also unemployment fell to 4.3% from 4.4%, which is odd. If job openings are falling, you would expect unemployment to be rising. We're getting lots of contradictory data out of the US currently. And in January, although non-farm payrolls reported plus 130,000 new jobs, challenger job cuts rose by 108,000. Now, reminder, it generally takes about 1 or 2 months for challenger job cut announcements to feed through to job cuts, but it's not clear that the US labour market is strengthening. Retail sales were weak, and manufacturing PMI showed an upswing, and the market has been betting on a US economic upswing in the past few months. So this is OPEC plus. This is their production. OPEC is the blue, OPEC plus is the red, and the market is forecasting that essentially OPEC has stopped increasing its oil production and it will not go through with any further increases. Turn to market news. Well, the precious metal rally came to an abrupt halt. Silver fell 30%. Gold and copper fell but have since stabilized. Bitcoin collapsed, down 25% over the past 2 weeks. Software stocks have fallen sharply in the US over fears that AI will undermine their business models following the release of Anthropic's Claude Opus 4.6. And oil has risen on tensions in the Middle East and reports the US has considered seizing Iranian oil tankers. So after the non-farm payrolls data, US Treasury yields rose and the expectations for interest rate cuts fell as markets absorbed as markets anticipated that the US labour market was not deteriorating and maybe strengthening. And this is the Japanese 30-year. And after Sanai Takichi's landslide election victory, you would have thought it would keep on rising, but rather the opposite. It has actually strengthened. The Nikkei 225 rose 8% over the past 2 weeks. And even the yen strengthened. And she is intending to increase the fiscal deficit and to cut the food consumption tax, which had previously spooked the market. But it appears that political stability hopes are trumping those fears over fiscal incontinence. And these are software stocks which are in free fall. This is an astonishing chart. So suddenly the market is worried that AI will erode the business models of software stocks. And that's because Anthropic launched Claude Opus 4.6, which has claimed superior performance to the latest ChatGPT model, but also, and this is what spooked the markets, features and it allows you to create autonomous teams of AI agents to tackle different aspects of complex projects simultaneously, which sort of mirrors the way humans would deal with complex projects. And those agents will work in parallel and communicate with each other to coordinate their efforts and divide tasks. So AI keeps on getting better and its impact on other companies is growing, and the market is now starting to worry about that. Okay, on to equities. Richard.
Thank you, Keith. Thank you for that excellent summary of what's going on in the world. This is 2 weeks.
2 weeks, yeah.
So the weekly movements are actually the movement over the past 2 weeks. So the FTSE All World was down a bit, the FTSE All Share up a bit, and the year-to-date changes for those two 2.8%, 4.6% respectively. Stocks Europe up 600. Sorry, the Stocks Europe 600 is up 1% over that period, 4.4% for the year-to-date. The S&P pretty much unchanged on the year, down last week. The Russell 2000 actually up 5.4%, down 2% in the last 2 week period. The Nasdaq is down 3% for the year and 5% for the last 2 weeks. The Hang Seng down 3.6% for the year and 4.4% for the last 2 weeks. The topics, as Keith referred to, it's very happy at the moment, up 12% year to date and 8% on the week. And Bitcoin down 25% basically for the year and the 2 weeks. Pound up 1.1% against the dollar in the year to date, and the euro up 1% year to date, and the dollar index down 1.1% year to date, and the VIX substantially up year to date.
Yeah, but just about to normal levels, you'd say.
Yeah.
It's like been astonishingly low.
Yeah. So we have the FTSE All World Equity Index.
Yeah, that looks like the uptrend remains firmly intact, frankly.
It does, doesn't it? Yeah. The FTSE All Share, likewise.
Yeah, just like the lack of volatility really is astonishing, given that the UK economy is not doing anything at all.
Yeah, agreed. And there's Euro Stocks 600, which is slightly flatter, but basically adopting the same profile.
Pattern. Yeah.
S&P 500, which
does that look like it's topping out to you?
It might be, mightn't it, Keith? It's been pretty flat actually for the last 6 or 8 weeks, but
yeah.
The Nasdaq definitely looks like it might be rolling over slightly, or maybe leveling off.
Yeah.
Russell 2000 is looking strong, as it has since April.
So the market, as we talked about last week, the market appears to be rotating towards general economic strength in the US.
Yeah. The Hang Seng, the topics looking good. Bitcoin not looking good. Although Bitcoin does have these enormous 50, 60, 70% drawdowns every few years. So it might be down, but it's not necessarily out. And it might yet have quite a long way to further to fall.
Yeah.
It's a pound against the dollar, which actually basically gone nowhere since July.
Yeah.
of the euro against the dollar, which is pretty much the same, and the dollar index, which is flirting with its low points, its recent lows. There's the VIX, which, as Keith says, is still very low, up a bit. And equity valuations are high. The S&P 500 static adjusted PE ratio is at 40, which is basically the second highest, only beaten at in 1999, I'm guessing there. The valuations are higher than the overall macro backdrop would indicate, but not nearly anywhere near the peak of the 2000 crash.
That's true, yeah. But, it can't keep on rising faster than the economic backdrop would indicate, would justify. But so far it has done. Previously when it's kept rising, it's just, it's calling a top has been a fool's game. So
the other thing, this chart is interesting, Keith, because it covers 65 years, and the volatility in it, given that it's 65 years old, I would say is not that big. The only really big outlier is the 2000. So it's
and also, as a predictive tool, it's not very useful in that, pre-GFC, it was saying the market was good value.
Yeah. This is Bitcoin and the US software index, which pretty damn well. So I start again. Pretty well correlated, certainly from 2021, and corporate profit margins at record high levels, and market expects them to remain there. That's
yeah. So I've got two contradictory thoughts. First of all, the US is not enforcing competition policy. So it's allowing, any firm to take over any other. So you're getting increasing market concentration, which could justify higher margins. Now, that is good for corporates, bad for consumers. But I think what's happened in recent days is the market is worried that AI is going to steal the lunch of a lot of US corporations and actually is going to erode their profit margins or destroy them. So,
agreed. I think we've entered a world of uncertainty recently with AI.
Yeah. And actually, while we talk about equities markets, Bitcoin, I came across this, and I thought this made a lot of sense. So, what this is saying is that the whole investment case for Bitcoin was based on the fact that there were only ever going to be a fixed number of Bitcoins in the world. And so the supply was limited, and it was therefore a very good store of value. But of course, the backers of Bitcoin and crypto have lobbied to get Bitcoin listed on the exchanges and for ETFs, etc., backed with Bitcoin. And that means essentially Bitcoin's de facto supply is unlimited because you can now write ETFs on it, write derivatives, swaps. One Bitcoin can back an infinite number of synthetic Bitcoins, and so its supply is no longer limited. And so when you look at the investment case, I think their kind of attempts to get it into the mainstream may have completely destroyed the business model. And so the Bitcoin is falling, and you can now create unlimited numbers of paper Bitcoin, short into rallies, forced liquidations. Actually, what does that mean?
It means you can, if people are margined, you bang the price down.
Yeah, no, that's true.
I think that's what it means.
Yeah. Whenever you need Bitcoin, you can get one, basically an artificial one on an exchange or whatever. So yeah.
These exchanges, they manipulate. They exist. There's a fundamental reason for these commodity exchanges to exist, which is to trade the physical commodity, and also to provide certainty for people who deal in the physical commodity, whether they're farmers trying to fix their price or miners trying to fix their price. But what's actually happened is that these exchanges, the regulations, there is so much money to be made from manipulating the market that these exchanges, the fundamental reason for their existence now is to manipulate prices for the benefit of the inside group. And I was struck yesterday, I read an article that the CME is looking to create contracts in rare earth metals. Now, think of the amount of manipulation they'll be able to do on small quantity rare earth metals with producing paper contracts of it. The whole thing. And I think, your point about Bitcoin is very well made, Keith. What's happening with gold, and I believe is also happening with silver, although it's quite a bumpy ride with silver, is that entities, individuals are now saying, we want the physical, give us the physical, we don't want these paper contracts, we don't trust them, because there's a shortage of supply. I'm not sure that the same thing, there is ever going to be any equivalence with Bitcoin, actually. So, this is just another money-making scheme by the exchanges.
Yeah, we have long-standing skepticism about Bitcoin, frankly, and it's not a store of value, is my fundamental view. And the fact that it's now the supply is, essentially infinite.
Another thing about Bitcoin, I think, is that I'm no expert on this, but although it's supposed to be sort of totally democratic, it is in fact controlled by a few entities. One of which was funded to an extent, by Epstein.
Really? Doesn't surprise me.
So I read, but what that means is that actually, Bitcoin is not what it purports to be. It is a whatever you like to call it. It is in fact de facto controlled by a few entities.
Yeah.
So I read a very interesting article yesterday by Hugh Hendry, who was talking about the role of Bitcoin and gold in economies and fiat currency. And I think he's basically, he thinks Bitcoin does have value, but the interesting thing about it, he was talking about the gold standard and fiat currency, and he was saying the problem with the gold standard is it's brittle. In other words, you can't flex it. So if an economy gets into trouble, you can't flex the gold standard. And so there's no way of ameliorating economic problems, where fiat currency allows you to effectively flex the currency to accommodate issues in the economy, and which is right, because you can change interest rates, you can do QE and all sorts. Well, and I thought that was a very interesting point, which sort of suggests that, to me, that there's nothing wrong with having fiat currency as long as it, to my mind, is backed by. So it is backed by, I would say, backed by gold, not that it's intimate, not that it's rigidly linked to gold, but it's backed by gold to ensure that politicians aren't actually capable of printing vast quantities of money in order to become re-elected. And it's like, you just need this. This is a bit of a digression, but we need to strike the happy medium between having a fiat currency that isn't abused by politicians and therefore by central banks, and not having a currency that's so rigid that it causes problems of its own.
Well, the thing is, Richard, I would say that we have got what you are arguing for, in that what we've done is we have anchored fiat currency to a 2% inflation target. Yeah. And so that should, in theory, stop the unlimited printing of fiat currency. Now, as we have seen, actually, it's flexible. When there's a pandemic, you print lots of money and make lots of debt. Now, the trouble is that nobody has had any constraints over the issuance of public sector debt. And fiat currency is within the remit of government, essentially. And if it comes to a question of government solvency or debasing the currency, the high likelihood is you're going to get debasement of the currency. And
Completely.
that is what the
Yeah.
investment argument for gold.
Yeah. And also, I would say that, I mean, you're right, the 2% inflation target in theory, but of course, we missed the 2% inflation target and we messed around with the measure of inflation to suit. So we haven't really, I would say that in theory, you're right. In practice, we don't actually have a 2% inflation target. We have a pretend target that we change
Mm.
depending on which way the wind is blowing and which is manipulated via hedonic adjustments and putting things in and taking them out and so on and so forth. So, but yes, I agree in theory.
Mm.
What you say is true. Yeah, we shall see.
So, but meanwhile, Michael Saylor, despite, Bitcoin's down like, was it 25% last couple of weeks, and Michael Saylor is saying only buy Bitcoin with money you can't afford to lose. Well,
You
with
can't afford to lose.
you can't afford to lose. And Trump, who came in on this, pumping up Bitcoin. Well, pumping up Bitcoin, it has resulted in enormous losses since then, since the start of his term for Bitcoin and the whole infrastructure. Sorry, the whole ecosystem. So onto commodities. So, quick summary, energy generally weak, particularly natural gas. So, warmer weather in Europe and the US has seen natural gas fall back to where it was a month ago. Industrial metals generally weak, following precious metals down, except for neodymium, which rose 20%. Precious metals generally weak, silver down an astonishing 32% over the past couple of weeks. And starting with energy commodities. So, actually, first, before we move on to energy commodities, this is the bull case for commodities. And so, this is the moving average return of the commodities index. And it does tend to go in these cycles. So, a positive cycle has started. And this chart tends to indicate when it started, it will continue for a while, he says, hopefully. So energy, well, Brent was down 1% over the past couple of weeks. WTI down 0.2%. Hurrah! Dutch natural gas futures down 19%, but still up 14% on the year. UK natural gas down 26% and only up 2% on the year. US natural gas subsiding again as the cold snap dissipates and warmer weather is forecast, down 15% on the past couple of weeks and 15% on the year. Coal going in the opposite direction, up 6.7% in the past 2 weeks, up 8% year to date. Uranium had a bad couple of weeks, but is still up almost 10% year to date. So coal going in the opposite direction. Coal and uranium, the winners. This is Brent. So up on tensions in the Middle East and skepticism over the oil glut. More on that in a bit. WTI, the same. But this the general trend
Mm.
remains downish in
What
order
I,
to need a break above the trend line.
yeah, I was looking at that. There seems to be a basin at around 55, doesn't there, on this chart?
Yeah.
But as you say, there's a trend of lower highs, but they don't seem to. We seem to have stopped having lower lows.
Yes, good point, Richard. So what's there? There's a wedge pattern, isn't there, where you
Yeah, yeah,
then you break out to the upside.
yeah. But it hasn't done that yet, has it?
It hasn't done that
It
yet.
is forming a bit of a wedge.
Yeah. Okay, so we have had EIA global inventory numbers for January, and they indicated a build of 15 million barrels over January. So that is 500,000 barrels a day, not 4.6 million barrels a day. And actually, it's worse than that because when you look at the revised numbers, they're saying that there was a build of 15 million barrels over the course of January. When you look at the numbers as I reported them last month, we were then saying, the EIA was then saying, global inventories were 2.9 billion barrels. They're now saying they are 48 million barrels lower.
How do they do that?
Well, they've revised their estimates of total inventories. And so after revisions, the January total oil inventories are substantially lower than their estimate for December. So their estimate for the size of the oil glut is falling, although they still think it's growing.
They need to run two separate data series, don't they? Maybe they do. All of these, they need to run a data series, which is the initial assessment,
Yeah,
and a data series, which is revised, and not conflate the two. Because
yeah,
if you conflate the two, you get very misleading statistics.
absolutely. So, and they don't store the previous
No,
piece of
jolly
data.
convenient, isn't it?
Yeah. Um, but over the past 2 weeks, US oil inventories have drawn down by an enormous 33 million barrels. So what happened was the cold snap in the US shut in some production, and that meant there was a drawdown in stocks. You know, US crude production is pretty stable, down 9,000 barrels a day over the past couple of weeks, but down 100,000 barrels since the start of the year. So has US oil production peaked? Question mark. The Baker Hughes rig count is up one.
The the rig count, it's not terribly comparable over sort of year on year, is it? Because of the technology that they use for drilling
Yes,
more and longer laterals. So,
that's true, but we've got quite a lot coming up in oil.
okay.
Um, so reminder, the IEA is forecasting that in Q1 there's been an enormous 4.6 million barrels a day, or that's what 4.5 million barrels a day in surplus, and we are just not seeing that. They're saying that the surplus will peak in Q2, but the stock build numbers are nowhere near that big. And this is the EIA, and it's saying likewise there'll be a build of over 3 million barrels a day. We're just not seeing that. We are seeing builds, but 500,000 barrels a day, still not good. And as a result of that forecast, the EIA is forecasting that oil prices will subside to around $50 a barrel. Now, actually, they've gone in the opposite direction. They've gone back to 68. And reminder that because we've had 20% plus inflation over the past couple of years, $68 dollars a barrel for Brent is the lowest it's been in about 20 years. So oil is dirt cheap. Venezuelan oil exports have bounced back in January after all the disruption caused by Trump blockading them, but it's not rising. It is going to take years for Venezuela to increase its production. Now, this is global oil inventories, according to independent sources, and they're not really growing. Although, what I would say is that this has been disrupted by winter storms in the US and a big inventory drawdown there. Let's see what happens over the next couple of months. OECD onshore crude inventories are low and falling, although this is misleading because the US has obviously drawn down a lot of oil under the Biden administration from the SPR, and it's just running systematically lower inventories. What matters, I think, is the direction of the trend rather than the absolute level. But the direction of the trend, according to this chart, is down. Although that again is caused by winter storms in the US. Floating oil storage appears to have peaked, but floating oil storage is not really storage. I listened to a very interesting discussion by the Oxford Institute of Energy Studies talking about the current state of the oil market. And this was from November 2025. And the professor being interviewed made some key points. And first one was oil on water is not storage, it's oil in transit that has been paid for. And the amount of oil on the water is a function of A, how much oil is being traded, and B, how far those tankers are having to go and how fast they're going. Now, when you disrupt oil supply chains through sanctions and force oil onto the black fleet, you are changing the patterns of oil trading around the world, and in particular, forcing tankers to go suboptimal routes. So those black fleet tankers are not, going between Rotterdam and St. Petersburg or Murmansk. They're going through Murmansk and to what, Iran or Singapore or Malaysia. And so you are forcing more oil onto the water for longer periods of time because you're disrupting the trade route. And that is behind the rise in the oil on water oils. It's not intentional policy to increase oil storage.
Yes, I guess basically, if it's sitting at anchor in tankers for months going nowhere, it's storage. But if it's actually being transported, it's not.
Yeah, exactly. Other points where demand has been systematically underestimated, and it is now consensus that from next year, non-OPEC countries will struggle to increase production, like full stop. So not increase production in line with demand growth, just increase production. Hence, I think oil has been rallying a bit. And the Oxford Institute of Energy Studies is skeptical about the oil glut narrative, and it expects the oil market to start improving from the second half of this year. Now, one of the reasons that people are skeptical about the oil glut narrative is that the oil is being absorbed into inventory because, for example, China is buying lots of cheap oil to put in its strategic stockpiles. But the background is oil companies have been reducing capital spending and boosting investor returns. So there has been a lack of oil exploration. And so, as shale slows, and we've got coming up a piece on US shale and the current status of the industry. So, as shale slows, there will be a lack of new projects from the non-OPEC countries coming onto the market. Now, let's talk about the oil glut. These are the current futures curves, and they're showing oversupply, but not 4.6 million barrels a day. That's not a glut. What they're showing is some easing in the oil supply situation over the coming months. But you'll notice the whole curve has shifted up dramatically over the past month on insecurity in the Middle East. If Trump were to attack Iran, then the whole situation could change. So what he's saying is that the futures curve only really indicated that they expected a glut in October and December last year. The glut narrative seems to have been unwound in recent weeks. Oversupply is not necessarily a glut. You've seen periods of oversupply previously, and the current period of oversupply, we're close to peak.
Mm.
And from now, yeah, go on.
Like I say, so where does Doomberg fit into all of this?
I don't know actually. Well, thinks that there's a huge gas surplus, which I think is difficult to disagree with because gas is a byproduct of all the drilling in US Permian. But on oil, what I think his point is that all the surplus gas produces a lot of surplus non gas
Mm.
liquids, which are essentially oil. It's light oil, very light oil.
Mm.
Um, but the reality is that the oil price is not pricing in a glut of 4.6 million barrels a day.
No,
And
sure.
if we are right that US shale has peaked, then his period of global energy overabundance may be coming to an end, he says. Fingers crossed.
Yeah, no, it's interesting, isn't it? It's very it has. I mean, the narrative has shifted, hasn't it? Very quickly.
Yes.
It seems to me, from there being, as you say, there's 4 million oil barrels a day to it not really being there, and it seems to have shifted in the course of about 2 months.
Yes, I agree. I know because you have been saying there's this oil glut narrative is wrong for months, and I've been thinking, well, the EIA and the IEA are credible and they must be right. But actually, when you look at the inventory builds, they are nowhere near 4.6 million barrels a day. They're about half a million barrels a day, and they keep on
But
being revised down.
yeah, so I'm afraid, Keith, that I'm a more cynical person than you are, and I just think that these all of these institutions are self-serving,
Right.
and that they will they're not independent, and they will put out what works for basically the US, and what works for Trump is low oil prices.
Yeah.
So I just look at it from that. I don't. It's like the inflation numbers. I don't believe the inflation numbers.
Right.
Um, you know, I mean, I'm not saying we've got 10% inflation. We've got two. I just don't believe when they say we've got 2.8. I don't believe we've got 2.8. I think we've got something
Right.
different, and that they manage the numbers in to try and. So I just think that I don't really believe these either official or quasi-official um,
Mm.
projections, because I think they have a different objective to my objective, and sometimes I'll be right, sometimes I'll be wrong.
Right. Well, I hope you're right on this one, Richard, because
Yeah,
I've
I
been
think
buying oil.
I think we live in a world of deep deception.
Right. Well, so the whole oil glut narrative is built on the fact that OPEC Plus opened the taps in 2025, increasing their oil production was what was it, 2.8 million barrels a day, which is enormous, and that they've got the potential to increase production by a further 1.2 million barrels a day. Now, but the reality is over their production has actually stalled recently and has fallen in January. Now, the reason for the fall was primarily Kazakhstan. So, Kazakhstan exports a lot of oil through the Caspian pipeline, and Ukraine has been bombing um, the Black Sea outlet of the Caspian pipeline, disrupting exports. But also, they had an outage at their Tengiz field in January, which caused major disruption, and that has been fixed. But you'll see that disruptions to individual fields are causing OPEC production to drop, which suggests that, how much spare capacity have they got? Question mark. Now,
It's always sorry, Keith. I just this. I'm going to make another cynical remark here, which
yeah,
is that it's always said that Saudi has oodles of spare capacity, and my question is, well, what if they're lying? You know, and why wouldn't they? You know,
well,
because they're
I,
playing a game as well.
I agree with you. I agree with you. You see that? I haven't got a chart of this, but anyone interested can look this up online. That Saudi onshore oil inventories have fallen a lot over the last 10 years,
Really?
and
Why?
well, because they've they've been, for strategic reasons or whatever. But
They've
the
been
question is,
distributing it
they've been distributing it
and
now.
not replacing it.
So, how much actually oil production capacity have they got when they're exporting? A lot of their exports are coming from storage. And it is now, what, 20 years since Twilight in the Desert?
Yeah,
Matt Simmons' book about peak oil and
yeah,
how Saudi had been searching for more oil resources but been unable to find them. And the Gawar field has been, which is still producing 5 million barrels a day, has been producing since the 1940s. And his point was that they'd been doing water floods, etc., to get more oil out. But at some stage, it is one field that produces still half of all Saudi production, and it's a finite resource.
yeah.
You can't keep on producing from it forever. So
No,
yeah, at some stage, and on your point, I mean, I think Saudi's reserve numbers are just a total fiction. We just don't know. And everyone has an incentive to make them as big as possible. And, as they
yeah.
produce, 10 million barrels a day, which is, 3.6 billion barrels a year, then their reserve numbers never go down. How's that work?
They know that they have finite reserves. We don't know how finite they are, but presumably their long term strategy has to be that they want to knock out as many other oil producers as possible, so that they
Yeah.
can then put the price up and max out on revenue until their reserves run out. I mean, that would be my long term strategy if I was them.
Yeah. Now, so what I think OPEC are doing is that they can see the oil market is falling back into balance. And they are then now going to have a return of pricing power because they are going to be once again the marginal producer.
Yeah,
Last 10 years, they haven't been the marginal producer, it's been US. And so any attempt to manipulate the oil price has been a total failure because the US just keeps on increasing production. But now they're basically restoring discipline to the group and as they expect their pricing power to return. So, briefly, onto oil geopolitics, because I thought this was interesting. So, I hadn't quite realized how much the US produces, including natural gas liquids. It is
mm,
huge, twice as big as either Saudi or Russia. Now, the opposite is true of China. China consumes between 15 and 16 million barrels a day, but only produces 4.3. So it imports around 1.1 million barrels a day. So US producing huge amounts of oil, China importing huge amounts. And when you look at where the choke points by which Chinese oil imports come from, well, there are a few that are within
mm.
US control in particular. So 80% of China's oil has come through the Straits of Malacca, 60% through the Straits of Hormuz. And obviously, the US has just sent a huge fleet towards Iran, which will impose more control on their ability to cut off Chinese oil supplies if, for example, China invaded Taiwan.
And also, of course, Trump is taking muscular action vis-a-vis the Panama Canal.
Yeah, yes, absolutely. In the meantime, US actions in Venezuela has cut off cheap Chinese oil from Venezuela to the tune of 350,000 barrels a day. Another aspect of Trump's seizure of President Maduro of Venezuela is that he has succeeded in cutting off Venezuelan oil flows to Cuba. And that means Cuba is rapidly running out of oil. So this week, it told international airlines that it would not be able to refuel them when they landed in Cuba. And that potentially disrupts their one major source of foreign exchange, which is tourism. So, um, is Trump going to succeed in creating a political revolution in Cuba. Many presidents have tried.
Yeah.
Bottom line, there are a lot of geopolitical moves by the US which are targeting oil and attempting to gain control of world oil flows, and that puts pressure on China. Now, is that deliberate? You'd think that that
I,
probably is.
I can't see that it wouldn't be. And I think Trump is desperate to keep the price of oil down because he knows that if oil goes up, then inflation
Yeah,
immediately becomes a problem in the US. I think he's desperate for that. But I think he can't. I don't think he can actually do it because of the supply demand.
yeah.
The
Well,
global.
it's like crypto, Richard. He's desperate to go, he wants crypto to go up, but it didn't succeed.
Yeah, exactly. But also, not only is he not necessarily able to do it, but is he fundamentally making the situation worse?
Mm,
One suspects that people
yeah,
respond. People respond to bullies by cutting the bully out of the equation one way or
yeah.
another.
Eventually, yes. It takes them a while, though.
It does indeed. So I think these sort of games they're full of unintended consequences. They're extremely difficult to predict. And
Mm,
what you've just gone through here suggests that an investment in oil as a generality is probably not a bad exercise.
So we'll go through what I've done over the past couple of weeks. And I've been very busy.
Oh right, okay.
Um, in due course. But basically, I've adopted your approach, Richard, in that so one of the things I've learned, and I've learned a lot over the past couple of years, is basically, listen to the market. And the market is saying it's skeptical about the oil glut. And I thought, you we've both been talking about moving into oil, and you've been doing it previously, and I've been saying, well, there's an oil glut, I'll hold on. And I just thought, don't hold on, listen to the market, buy some oil. So I bought a lot of
Yeah.
oil.
At the moment, the prices are generally very depressed, aren't they? So your downside actually is quite limited.
Well, I mean,
And
it could go down to 50. We're people previously talking about it going down to $50 a barrel, but you know, that that's unsustainable. So if it goes, totally pear-shaped, I've got, limited downside. And I've got, this is a decent chunk of my portfolio, but it's not an overwhelming amount, and I can simply switch the rest into oil, which I would absolutely 100% do
yeah,
because that's unsustainable and it'll come
yeah,
back up. So these are EU natural gas futures. They've come off nicely as the cold weather has passed, but not back to their lows of December. But still, that well down on this time last year. This is the UK, and those are right back down to their lows, and that's great news for UK consumers. US natural gas futures can't sustain any rally, basically. There's a lot of gas in the ground. You just have to go and drill for it. But US liquid natural gas exports are surging. Will that bring the market more into balance? Question mark. This is coal spiking up, uranium, bull market very much intact. And if you look around the world, there are a lot of nuclear power stations currently either being planned or being put into construction, coming online in the near future. That should support uranium price. Richard, have you got any preferred uranium equities?
no, I find them difficult. So I sort of let me just have a look. See, I think Sprott Junior Uranium Miners. I'm
Mm,
not advocating one way or the other, but it's one of my holdings. I think the trouble with nuclear is that a lot of these companies don't have much in the way of production,
yeah,
so you're having to take a bet on um, that they'll get it out of the ground, and when they get it out of the ground, the price they get is more than the cost of getting it out.
yeah.
I think it's difficult. So I prefer ETS because although you might miss out on some big winners, you're not doing the. I prefer ETFs.
Okay. Well, that's interesting. I might have a look at that.
Yeah.
Junior uranium miners, see how it is. And on to industrial metals, Richard.
Thank you, Keith. So aluminium, well, pretty much year to date, everything is up except iron ore, which is down 6%, most of which happened in the last 2 weeks.
Mm.
But quite a lot of these miners have got, of these commodities have gone down in the last 2 weeks.
Yeah.
So aluminium down 4.5%, copper down nearly 3%, iron ore down 5%, lithium down 16%, but still up 21% on the year. Neodymium, actually, the exception here was up 20% to 41% for the year. And so nickel down nearly 6%, tin down 8%, zinc down nearly 2%. And I suspect what's happened is that the sort of commodity bull meme has got a bit ahead of itself.
Yes, I
There's
agree.
been a lot of speculation jumping in, and that speculation has been washed out.
Yeah.
So there we have aluminium, still on a healthy uptrend.
Yeah.
Cobalt, copper.
Okay. Now, I'd like to talk about copper because, previously, regular viewers will know I moved into copper big back in November, and I was just very surprised by how quickly it moved up. And so I was at my desk 2 weeks ago, and I saw copper basically move from $6 a pound to $6.6 a pound within the day and then come back down. And I thought, you know what? This has all just got a bit of a head of itself. And I halved my position and then I felt good about that. So I came back to my desk and I halved it again. And so that was all on Thursday, the 29th. And since then, I've actually further reduced my position to just a rump. Now,
So you're the cause of the crash, Keith.
well, I'll be interested in your view in due course, Richard. But so this is Simon W.'s technical view. And he's saying that he thinks that tactically, copper is overbought, but it has stabilized around $6. It could fall to 6.7, 6.9. Sorry, it could fall to 5.7 to 5.9, but dollars. A fall to $5.3 would remove any risk premium. It would be basically back towards fair value. But strategically, he's saying the bull market is still intact. Now, I, on the other hand, think it's not. So I think copper got way ahead of itself when it was up 30% since November. And to me, what happened on Thursday, the 29th, looked like a blow off top, driven by Chinese speculation. And in particular, I think what's been going on is that there's been stockpiling of copper in the US to get ahead of potential tariffs by the Trump administration. And the mechanics of that are that once those tariffs are announced, stockpiling ceases and those stockpiles come back onto the market. And that is a potential catalyst for the unwinding of the price spike. Also, there is currently no shortage of copper, although there will be one in the coming years. And I fully intend to re-enter copper when I think it's back down to fair value. Richard, your thoughts?
Yeah, I agree. There is currently no shortage of copper, and there almost certainly will be a shortage of copper over the next few years. So I'm not in the metal, unlike you, Keith.
Right.
I think you timed that very nicely, clearly. I'm in mining shares, and so
Yeah.
I'm in them for 10 years, I think.
Right.
So I'm just holding.
No, so to be clear, Richard, I'm not in metal. I had bought a load of copper mining companies, individual ones.
Right.
And then if you remember in December, I sold all those and I switched into 100% in the ETFs because they were very liquid. And that worked really well
Yeah.
because when I decide to sell, I sold the ETFs in size in big batches
Yeah.
and you
Which you
can
can
do
do.
that. You can do,
Yeah.
whereas you can't do that on the individual
Yeah.
names.
No, I mean, you're very well there, Keith, and well done. I haven't sold any copper. I actually haven't sold any shares across my
Right.
portfolio, full stop. Um, and I'm just sitting and waiting because I think no, that's where
Yeah.
we're headed. And
Yeah.
I don't trade because I find it too difficult to. I
Right.
particularly find it difficult to get back in, and
Right.
and so I have learned that once I've sold something, I find it really hard to re-enter it. And then I
Well,
wish I had, so I wish I hadn't sold it in the first
yeah.
place.
Well, with CGT being what it is, yours is a very wise positive policy. I thought it had just gone too far too fast. I was
Yeah,
uncomfortable. Now, so this is the FTs, I've taken it from Bernstein Research, their estimate of where the supply balance is in the copper market. And you'll notice 2025 big surplus, 2026 still a surplus.
yeah. And then
So
2027, which is now 11 months away,
absolutely, we
first year
start
of
to get
deficit.
exactly. So, but this is the bottom line for me. Okay, so current tightness in the copper market is being driven by mine disruptions, which will ease over the course of the next year, particularly given the copper price has gone through the roof and everyone is incentive to get those back online, but primarily because tariff fears have driven copper stockpiling in the US. Now, how this works is that the market is expecting Trump to put tariffs around 15% on refined copper. It's already put 50% tariffs on semi-finished copper products. And Trump administration is due to report back and impose tariffs or not by June. So let's say the copper price is 100 and Trump puts on tariffs of 15. If you buy copper now and you stockpile it, your cost is 100 and the price in the US market is 100. If Trump puts in tariffs of 15%, then and the market price remains 100, the price in the US is 115, and you can sell your copper, which you bought at 100, for 115 because that's the market price. So the moment tariffs are imposed, or that uncertainty ends, all this stockpile becomes available once again to the market. And I expect that to drive the copper price back down, at which point I rebuy, basically.
Very good.
So that's the idea.
Well done.
Um,
I look
and
forward to seeing how it works out, Keith. I mean, it sounds very sensible.
yeah, so we'll see. But yeah, the bottom line is, as we go through this, we're basically energy. The world needs energy. Demand is growing. For energy, you need either oil or you need EVs and electricity that requires copper. Both of them we think are going to be in demand and increasingly scarce in the coming decade. And this is a trade. But basically, by the end of the next 2 years, I will be primarily in copper and oil. Full stop. Um, But when you look at the price of oil versus the price of copper, the price of copper has gone through the roof. The price of oil is dirt cheap, basically, compared to, inflation adjusted, it's back to its 2000 levels. So I just don't think that's sustainable. And as the oil production shock from shale fades, oil price goes back to where it should be.
Yeah.
But meantime, while copper prices are at these levels, copper companies are absolutely printing money. when we talk about just the prices of metals this year, it's been driven by lots of speculation in Shanghai. And you notice how the amount of open interest has collapsed over the past 2 weeks with metals prices. And there is a lot of copper in the ground. Now, this is misleading because what you want is concentrated copper that you can mine. And actually, what we're doing is we've mined all the really concentrated deposits. We're struggling to find, similar ones, and so we're increasingly mining lower ore grades.
Yeah, and that increasingly becomes more expensive and more energy dependent.
Exactly. Now, the other thing that influenced me was this report from Goldman Sachs. Now, they're bearish on copper, and what you need to um, assimilate is this chart here. The red line is Goldman Sachs's forecast for copper, and they're saying copper has got ahead of itself. Yeah. And the reasons are the tariffs, as I've explained, but also in 2025, the copper market was in surplus to 600,000 tons, the largest since 2009. So they're expecting high prices to boost recycling and dampen demand, which I think it will do at the margin. So there's going to be, um, I just think the market's got ahead of itself, basically. And I'm expecting when those stockpiles come back online, the copper price to head back towards $10,000 a ton. Now, Goldman Sachs are forecasting that it'll go towards 11,000. Happy with either, frankly. But I think it's down from here. We'll see. Back to Richard.
So it's iron ore down 6% on the year to date. Lithium up on the year, down heavily the last couple of weeks. Neodymium, nickel.
Yeah, so you were right, Richard, that the Indonesian government has cut quotas by more than 100 million tons. But that was already in the price. So when it's been announced, the nickel
Yeah,
price has actually fallen.
yeah. Tin.
Bull market very much intact, I'd say, frankly.
Yeah. Zinc.
Same here. Somebody must be buying a lot of brass. What else do you use zinc for? I suppose like
It's for
yeah, sacrificial anodes for
yeah, and also you coat steel with it, don't you? Something from rusting. What's that called?
yeah, that's
Galvanizing.
galvanizing, yeah.
Precious metals. So, well, very interesting, interesting time for precious metals.
Yeah.
Year to date, gold's up 15%, silver 9%, platinum down 1%, rhodium up 17%, palladium up 2.5%. So obviously the big, I think gold actually, it has been quite volatile, but much less volatile. The real volatile one amongst them has been silver, which had that
Yeah.
enormous 40% or so fall at the
Yeah.
beginning of February.
Yeah. It's amazing. It's down 32%, but still up 9% on the year, which is only 6 weeks ago.
Yeah, yeah, exactly. I mean, I think basically the silver is in deficit. It's projected to be in deficit for many years to come.
Right.
Just think it's like sitting there and ride it.
Right. Okay.
So that's, I mean, gold actually just looks like it shouldn't really have bounced up to 5,500, and it's resuming
Yeah.
its trend.
It does, doesn't it? Yeah.
And what's Simon saying, Keith?
So Simon's saying that it's overbought, but holding the 5,000 level. Downside to 4,500 is possible, but strategically the trend's intact. It's bullish. Just like you, hold on.
Hmm.
Noisy around an upward trend is what he'd say.
Yes, that sounds like a very, very good description. Chinese gold ETS or record outflow. It's off the market route. So, yeah, a lot of speculation going on there.
Yeah. And actually, quickly, while we talk about gold, there is XAUT, which is a big buyer of gold. Now, what
This
is it?
is Tether.
Yeah, it's Tether. So it turns out Tether is the in Q4 last year was the world's third largest buyer of gold behind the central banks of Poland and Brazil. So Tether produces stable coins, and one of their stable coins is XAUT, which is backed by gold. And down here you can see it holds 1,800 gold bars, well, that's 22,000 kilograms, 22.2 tons of gold. Enormous. And this is quite interesting actually, because the only fees for holding it are 25 basis point fee when you buy or sell it. So a 50 basis point spread. Now, if you are to like buy physical gold and store it at the Bank of England, they will charge you a fee of 1% a year. So actually, this is quite cheap if you don't buy and sell it.
Mm.
And as you'd expect, its price has tracked the gold price, but its market cap has absolutely exploded as people have been buying it and it's been creating more units. So it's risen from 188 million in 2022 to 2.6 billion now. Tether's total gold holdings now exceed 23 billion, has a total of 148 tons of gold because it's not just its XAUT that it's been buying gold for. It's been shifting some of its assets which back the Tether USD stablecoin into gold. So there you go. As long as that continues, there's bid for gold.
It's interesting, isn't it? Yeah. So here we have silver with that sort of parabolic top back down. It went down to, I think, to the mid 60s was its low point. And it's now had sort of quite a large, it had a 10% drop yesterday. It's up a bit today. Very noisy, very volatile. I think the thesis is in place. I think the journey is quite uncomfortable. I think that, as I said earlier, it's still in deficit, will be in deficit for many years to come. And so you just have to hold it. Don't buy it on leverage.
What silver miners do you like?
So I have Discovery, Heckler. I've got Dolly Varden, and I've also got SILJ, which is the Junior Silver Miners ETF.
Very good.
And then I've got a couple of somewhat speculative little ones. Having said, I wouldn't buy speculative uranium mines, which I could tell you, but privately, obviously.
Right. Very good. Thank you, Richard.
So what's Simon saying about silver?
So actually, this is a chart from week 203.
I remember this one, yeah. And he was saying sell, and I said, oh no, I didn't say sell. I said it's a new power. It's moving it to a different pricing model structure, which I believe it is. And I didn't sell anything, and it did duly, as we know, it duly fell very dramatically. So he was right. But I think that the long-term thesis is perfectly intact.
Okay. You see, I think we are now going through one of these cycles where you're going to have a great deal of volatility and then it's going to come back down towards trend, frankly. So this is his view as where we are now. So the sell-off has occurred as predicted, and he remains concerned about further downside risk. Not a prediction. I think we're here. Frankly.
It depends what the timing of that cycle is, really, Keith, because if you look at it over a 10-year period, I think we're probably just at the start of the increase in the price of silver over that period of time.
Okay.
But within that within that 10, if I'm right, within that 10-year cycle, there may well be a number of these events.
Yes. Yeah. Well, I'm going to add your um the silver companies you've suggested to my watch list, and if it comes down, I'll buy some, but not now. We've talked previously about the dangers of leveraged ETFs. Well, yeah, on Friday the 30th, when silver fell 30%, holders of the two times leveraged silver ETF lost 60% in a day. Yeah, these are dangerous things.
As the price of silver has increased over the last couple of years, its proportion of the input cost into solar panels has risen hugely.
Absolutely.
And the only, as has aluminium actually, but then as is aluminium, and the others have remained, I guess. The actual
Yeah.
net value, the actual absolute value has changed very little, relatively little for the others. But it's
Mm.
pushing up costs for
Yeah.
significantly pushing up costs for panel producers.
So we know that, solar panel prices in absolute terms have fallen enormously over the last 20 years, but are rising input costs going to reverse that now?
Yeah. So there we have platinum. Um, Again, it's sort of dropping back to that longer term trend, isn't it, that you can see from May?
Yeah.
I don't think it's there yet, but it seems to be dropping back towards it. Rhodium didn't really drop back very much, did it? And palladium dropped back quite a lot.
Yeah. Okay, thank you, Richard. On to rates. Very disappointing, basically. So at the short end, UK rates, market's expecting to bottom at 3.5. Frankly, we could get 3.5 next month when Bank of England meets. I think that's just wrong. But not coming down at the long end. You know, over the course of the last year, the short end has come down, long end has risen. Now, in theory, the neutral rate for interest rates should be inflation, which in the UK is let's say it settles down to its historic norm of 2.5%, plus economic growth, which is 1%, as we've talked about. So that's in neutral rates about 3.5%. So if you wanted to lend to the UK for 30 years, you're getting, up here 2.5%, 2.2% real. And that is the risk-free rate. So enterprises are going to be paying very real high interest rates. And that is a drag on economic growth that I just don't think is sustainable given our anemic growth, frankly. But so far, I've been dead wrong. This is the US, where actually the whole yield curve has shifted down. So I think the markets are charging the UK a huge instability and like credibility premium because we haven't got the deficit under control. China has been steadily dumping its US Treasury holdings and buying gold. So that doesn't seem to have driven up US yields, though. So this is the UK 2 year, and it is coming steadily down. Now, I think that's going to keep on coming down to 2.5% as inflation comes down. On Richard's point about how, fiat currencies are, manipulated, etc. If inflation comes down to 2.5% and growth remains at 1%, there's no way the Bank of England is going to keep interest rates at 3.5% or 3.75%, i.e., positive real interest rates. They're going to go to negative as soon as they can, frankly, to stimulate the economy. UK 10-year, not great. 30-year, really not great.
Sorry, Keith, just on that though, but the Bank of England can't do that if the buyers of gilt say we're not going to buy it at that rate.
Sorry, they can, Richard. The short term, they can. They can
Yeah,
say what they can do. They say, you set base rates, and you set you know you the short term gilts. The price is basically set in the market technically by the Bank of England's you know what it will lend in the overnight market, which is set by interest rates, is that as you get further out the curve, it's set increasingly by the market. Now they can't control longer term rates without doing QE or something. But
yeah. So at what point does it become um, ineffective to manage short-term rates below what is the market rate? Because that is probably what they'll be doing. Rachel Reeves's borrowing requirements don't lend themselves to lowering interest rates. So at some point, it doesn't work anymore, and doesn't.
well, when you say that, Richard, I mean the what matters is inflation. If inflation comes down towards target,
Yeah, but I'm saying if let's say your scenario, you've got 2.5% inflation, 1% and 1% growth.
yeah.
Rachel's continuing to want to borrow vast quantities of money.
Mhm.
The Bank of England wants to reduce interest rates, but basically the market says no, we're not going to buy the gilts at this rate. You say, well, Bank of England will just issue lots of short-term gilts, but at some point, surely the market will say, well, we're not buying those either.
Well, the reality is, Richard, it's in theory that could happen, but in practice, it doesn't tend to. When you're issuing loads of debt, you're also putting a lot of money into the banking system, and the banks will buy the debt because the alternative is to lend to the Bank of England at lower interest rates than you can get in the debt market. Well, as we've talked about before, what happens when the fiscal deficit is out of control is that the state can artificially suppress interest rates. Look at Japan. What they can't do is support the currency. And so what you tend to see is, surely, certainly at the short end, artificially low interest rates, but the currency going through the floor. Now, if you have an
Which
independent central bank, it should then start raising interest rates because inflation's going up.
exactly, yeah. So yeah,
Yeah, so you get into a well. Let's see. Let's hope
yeah.
we never get there. So this is the US 10-year. Unlike the UK, it's kind of coming down. It's still not at its lows. And sadly, the moron premium is growing again because UK is perceived as having political instability. So Starmer appears weak, and if he were to go, I think we'd all be worried about what happens next. Ed Miliband, when Ed Miliband rules himself out of being a Labour leader again. I mean, the fact that that was a mere possibility is enough to to send shockwaves and fears through everyone, including me.
Makes you despair, doesn't it? Having a it's like,
Yeah.
for goodness sake. We are
Um, Gone.
what have we done to deserve our last decades worth of politicians, Keith, 2 decades?
Yeah.
We worked hard, we did our best, we got these plonkers.
When you look back at the UK prime ministers the last 20 years, are there any of them you've actually liked?
Not that I can think of, no. How about
I,
you?
th- I thought Theresa May started well.
Oh, Theresa May, yes, yeah, I think she did. And then she was basically
Yeah.
shafted by Brexit and all the shenanigans around
Yes.
Brexit, wasn't she?
Exactly. Yeah.
But yes, and I think she's a fundamentally an honourable person, which I think is not what could be said about most of them.
Yeah. Anyone who followed. I mean, and Rishi Sunak, well, I think history is going to judge him very badly for his time as Chancellor.
Oh,
Yeah.
absolutely appalling.
Yeah.
So grossly irresponsible. But gloating,
Yes. You
I'm
know,
I'm hugely irresponsible, aren't I? Clever.
yeah. Everyone loves you when you like hand out money like sweeties.
Yeah.
Anyway, back to main topic. German 10-year coming down. That's quite good. French, the bond market's a funny thing. Because the France is just fiscally irresponsible in a political crisis, and its bond yields coming down.
Yeah.
Um, Italy looks good. Greece, okay. Even Japan. So the uptrend is still firmly intact, but the market has taken the landslide victory of Sanai Takichi and her fiscal irresponsibility very well. And on to current investment themes. So a few changes here, actually. So
Oh, it
number one,
changes, Keith. You can't change your investment theme week by week.
yeah, well, we do, mate, especially when like silver falls 30%. So anyway, AI development, AI disruption,
No
that's new.
conviction.
AI disruption, that's new. That's like software companies going through the floor. Monetary debasement, still a theme. Commodity scarcity, energy abundance, peace in Ukraine? Question mark. Actually, well, the Ukrainians are talking about having a referendum about any peace plan, and the Trump administration is talking about having peace in Ukraine by June. We'll see. Political uncertainty, financial deregulation, and new one, fads. So, AI, well, AI has risen relentlessly, but, and I put this is new, I think it's topping out. We've been saying this for a while, but Nvidia can't keep growing at current rates forever. And at some stage, its growth starts to slow. And the analogy is with, for example, Zoom, where Zoom's share price peaked back in 2010. And since then, its revenues have gone through the roof, but its share price has collapsed because all the future growth was in the price. And I think the same is going to be true of Nvidia. But the market is increasingly worried about a bubble, particularly the bond market. So the CDS on the bonds issued by the hyperscalers to pay for their AI capex, the CDS has been rising, which means that the markets are worried about the default risk of, for example, Oracle. And there has been a rotation away from AI towards resource stocks. So the market is, its previous enthusiasm for AI is fading. But what is new is the market is also now worried about the effects of AI on other businesses, particularly software shares, which have fallen very sharply in the past couple of weeks. Something to be aware of. So the market, if you look at the last year, the market has rewarded equipment makers, but it's been punishing companies that it fears will be the victims of AI disruption. And this is really starkly shown here. The AI software basket, which includes Palantir, falling sharply, gone nowhere for a year, now coming off. Be warned. Now down over 30% from their peak. And there are some big names in this, like Microsoft down 26%, Palantir down 34% from idiotically high levels, Oracle down 56%. And when you look at the Magnificent Seven, well, they ain't looking so magnificent anymore, frankly. Topping formation, the Mag 7 is now down on the year. So on the monetary debasement theme, well, gold and silver have risen relentlessly. Have they peaked? Well, my take is that gold looks like the bull market is still intact, frankly, but silver and the others not so sure. Commodities have been rising, and frankly, we've had a little wobble over the past couple of weeks, but from those charts, it looks like the bull market is still intact. Bitcoin, yeah, bubble gone. Bonds remain out of favor. The yen continues to fall, frankly, although it's had a bit of a stabilization race recently. I promised you a piece on possible fiscal crisis in Japan, and now I'm back. I will be working on that and on a piece on copper. Um, US tariffs, will they be declared illegal? The Supreme Court can rule any time on that. If they are, then what will Trump do? There's no chance he's going to raise taxes. So either he finds another way of imposing the tariffs or the fiscal deficit blows out in the US. Commodity scarcity, we like copper, tin, and uranium
And
and,
silver.
and silver. I'll add that actually.
But be careful.
This week, what's new is fads. And so I was thinking, we've talked relentlessly, and I think Richard's been ahead of me on this, but we've talked relentlessly on the podcast about how inequality is massively bad for young people and how the house prices in the US and to a lesser extent the UK shot up by 50% since 2020 during the period of the pandemic, making houses unaffordable. But what the sort of realization I came to over the past couple of weeks was that the that has coincided with the development of Robin Hood and in the democratization of stockbroking services and the ease with which you can now speculate in financial markets. And so what you have is a whole cohort of young people who desperately need a big win in order to be able to afford a house and everything that my generation takes for granted, with the increased ease with which they can speculate. And hence, in the past few years, we have seen just an endless number of financial bubbles. Any investment fad gets blown in far higher than I thought was remotely possible. So Simon W. obviously has been totally right on this, but it's been new to me, and I've come to the realization that actually there's a whole cohort of people out there who are looking to get rich quick and wanting to jump on any fad. So going forwards, we will be systematically on the lookout for potential bubbles, and I'll be putting money into anyone I can find. Richard, your thoughts?
The trouble with putting money into bubbles is by the time you spot it's a bubble, it's too late, isn't it?
Well, the thing is, I mean, in the case of like copper, so I'm less good at getting in. I'm much better at getting out than getting in.
Yeah,
Frankly.
that's true. Well, you did very well there. That's true, Keith. Completely agree. I think income inequality means young people need massive increase in their wealth to be able to afford a house. Absolutely true. I mean, the system has totally screwed them, and it's immoral what our politicians have done to young people, and continue to do. Rachel Reeves making the changes to the repayment rates on student debt and so forth. That's totally immoral. I mean, does Rachel Reeves have a student loan? Does she have a child with a student loan? It's just utterly unforgivable.
Yeah.
And then, of course, people are desperate to try and get, but this then, what it means that you can't make a decent living doing a good job. You have to speculate on the stock market.
Yeah.
And who makes money out of speculation on the stock market? Answer: the banks and the hedge funds.
Yes.
And so you're saying, and while you're at it, we'll have some of your money that we're going to save for a house. We'll take it from you, because you can't make money speculating. So because they've got it all wrapped up. So the whole thing, sorry, Keith, the whole thing is just a mess.
Yeah, but going forward, if you see a bubble developing,
Keith's in it. In fact, if you see a bubble developing, Keith has started it with his new Twitter account.
Well, this is very much a new policy. Like,
bubbles are us.
Yeah, exactly. Total reverse ferret. I'm going to be buying bubbles.
Mr. Bubble.
Yeah. Okay, and on to economic data. Quick summary. So UK stagflation turning to stagnation. I mean, the economic growth numbers are really bad, frankly. Inflation has hit a near-term peak and seems to be coming down. Fingers crossed. EU stagnation. We are back to pre-pandemic norms. Low growth, low inflation. US odd and contradictory. Nowcasts suggest that the US economy is just fine, but labor market, I mean, despite the January non-farm payrolls, the all the indications are the labor market is weak and the consumer is softening. China investment continues to weaken, but the economy continues to grow at around 4.5%. And onto the UK.
UK interest rates unchanged. GDP growth, not, as Keith said earlier, 0.1% in quarter four, below expectations of 1% for the year. So really, really anemic.
And this is super bad, actually, because when
Yeah.
you look at like the last, 9 months of 2025, you had total growth of 0.4%, and that has big knock-on effects for the UK fiscal balance because,
Well, yeah. I mean, this
yeah,
is what happens when you tax an economy to death, isn't it, Rachel?
yeah, exactly. But
It's like just no inkling of an understanding of what's going on.
yeah, well, the sadly, the deficit is not going to come in on target, which means she's likely to raise rates again because she's utterly incapable of cutting spending.
She's shafted herself. Oh, there we are.
Yes.
Yes, that's a very apt cartoon. UK business investment down, just what we need. Someone should listen to Jim Ratcliffe and his constant complaints about energy prices in the UK, and maybe
Yeah.
David Miliband should consider listening to him. Although
Ed Miliband.
Ed Miliband.
Yeah.
Although Ed Miliband, I think he's on top of his brief.
I'd like him to be on top of his brief somewhere in the Arctic Circle.
or under it.
Yeah, exactly.
UK business investment year on year 2%, lower than expectations in quarter four. Industrial production down 0.9%, worse than expectations in December, and year on year 0.5% worse than expectations. And basically, the economy is just doing not very well at all.
Yeah. Well, in industry is going to struggle with these high electricity prices.
UK construction output year on year is down 0.3%, actually a bit better than expected.
Yeah. Yeah, but the construction industry is also stalling.
Yeah.
High interest rates are not good for when you want to fund long-term projects.
No, it's not, is it? And UK mortgage lending was actually very slightly up on expectations, 4.6. That's sort of basically what it's been mostly for the last few months.
Yeah, you've seen that, what Santander offering 98% mortgages.
Consumer credit was 1.5 billion in December, slightly lower than expectations. And net lending to individuals in line with expectations. And UK construction PMI 46.4 in January, so confirming that the UK construction sector is not in a great place. House prices month on month up 0.7% in January, and year on year up 1%. UK goods trade deficit was 22.7 billion
in 1 month.
In 1 month. I mean,
amazing.
But I think if we increase taxes and social welfare payments, that should encourage people to buy fewer imports, shouldn't it?
Yeah, not.
UK balance of trade 4.3 billion in December. I mean, I just think that surprise index should be down on the floor, shouldn't it? I'm constantly surprised.
Yes, I agree with you, Richard. There's credibility. Given that, economic growth is 0.1% in Q4, this is yeah.
Yeah. The Indeed jobs postings index is sort of bouncing around a bit at that level. It has definitely plateaued, hasn't it?
Yeah, well,
maybe slightly down.
Yeah, losing momentum again, I'm afraid.
Yeah. Wage growth 4.3%, so that's falling back, which is sort of good news from an inflation point of view and bad news from the point of view of people being able to afford their own houses, etc.
Yeah.
and their rent. Trueflation 2.8, and there's a nasty upward trend forming there.
There is. That is not good.
But Keir Starmer told us that he would get cut inflation.
Mm.
I feel that maybe the inflation statistics need to be adjusted.
Need some hedonic adjustments, Richard.
Yes, we do, don't we? Yeah. Okay, so 29-30 UK budget plan includes a 5.8% real terms cut in unprotected departments, which includes prisons, courts, probation, adult and children's social care. I mean, prisons, courts, probation are an absolute shambles.
Yeah.
Can't cut money from them. They need investment, not cuts.
Yeah.
Adult and children's social care is such a huge budget. I think something needs to be done to address that. But you can't.
Well, you've seen that basically the Labour government's totally incapable of cutting spending. So for example, on the triple lock, you've seen that, there was in London, there was talk of removing the free tube rides or bus fares for over 60s and promptly reverse ferret because there was, OAPs were complaining. And I absolutely fail to see why OAPs should be given preferential treatment over, young people. They've got houses, etc.
I completely agree. The world has gone upside down.
Now, Richard, before you look at this chart, calm down.
Okay, deep breath. Oh, look, the entire GDP growth in the UK since 2019 has been driven by government, not the private sector. A very similar picture emerges in Germany. So can I just say that I rest my case?
Yeah, and I would also say that measuring output from the public sector is very difficult. How do you measure the output of, let's say, the NHS? When you dig into it, it's a series of statistical fudges.
No, it's very simple, Keith. You measure the input, which you know quite accurately. You assume a certain level of productivity, which you can vary.
Yeah.
And that gives you your output. And then you stick that in your GDP number. So actually what I don't really understand is why we haven't got higher GDP, because they've fudged the productivity of the public sector. Or maybe that's what they'll need to do next.
Well, I think Richard, what you're seeing is exactly that, isn't it?
I mean, yeah, what's happening is that the government is borrowing vast sums of money from the future, and that money from the future is being used to artificially boost economic activity in the present. And at some point, that artificial boost, that artificial GDP has to be paid back. You can pay it back by balance sheet recession or by debasement of the currency. That's the only way you can do it. Balance sheet recession means economic mayhem. Debasement of the currency means everybody gets poorer.
Yeah. Right. Heard it here first. Buy gold, says Richard. Not investment advice.
I don't believe this. This is just wrong. It's got to be true.
Yeah. No, we're winning at something. It's just like we have the most expensive railway in the world, as like last week. Now we also have the most expensive electricity. This is something to celebrate. We are top of the league in something, Richard.
But I thought Ed was fixing this.
Well, he has. That's it. We're top of the league.
Oh, right. I didn't realize his objective was to make it as expensive as possible. Yeah. My mistake. So there's the summary. Bottom line, stagflation. Stagnation. Economic disaster.
And actually, when you look at the trueflation numbers, it's stagflation rapidly turning back towards stagflation. Anyway.
Yeah.
Now, interesting. So thank you very much to PHS on our Discord. So previously, whenever it's the Norwegian Wealth Fund has come up, I have said that, the UK squandered its own North Sea oil wealth, and he pushed back and he made some very interesting points, and I've changed my mind. So this is the Norwegian Wealth Fund, which invests its oil revenues from the North Sea into a sovereign wealth fund for the benefit of the entire citizenry. So that is now worth an astonishing $350,000 per citizen. Now, what happened to our own North Sea oil wealth? My previous position was that Maggie had squandered the whole lot on welfare payments. And um, yeah, we should have done something the same as the Norwegians for the benefit of future generations. Well, the first thing to note when we consider this problem is that the UK's oil tax revenues as a percentage of GDP were nowhere near the level of Norway's because the UK has a larger economy and lower oil revenues. So it peaked at around 3.1% of GDP in the mid 80s, and that peak was relatively, I'd say, brief, as opposed to Norway, where it's been over 10% of GDP at peak, and it's been substantial for a very long period of time. It's now over 6% over 6% of GDP as of 2020. So much bigger. So what are the arguments in favour of the UK establishing a national wealth fund? Well, number one, I'd say, is intergenerational fairness. The mineral wealth of the UK belong to everyone, including future generations, not just people who were alive in like 1980 and 85. And that money could have been invested in UK businesses and infrastructure. So could have been put in a fund that invested in, domestic industry and businesses. And we have poor domestic investment relative to other members of the G7. It would have been good. An independently managed sovereign wealth fund would have seen the oil wealth multiplied with time in line with the stock market. The stock market is up 20-fold since 1980. So this is our gross capital formation in the UK. We're the bottom red line. So we could have used it to boost our investment. And this is the stock market. This is the FTSE 100. If you invested in the FTSE, would have gone through the roof. So there are good arguments for having why we should have established a sovereign wealth fund. And those have been my arguments previously, but as PHS points out, essentially Britain was in one hell of a state back in 1980. And the then Conservative government used the money to stabilize the economy. So, reminder, in the 1970s, Britain was a basket case with very high inflation, out of control labour unions, and it had put in capital controls to support the currency. So if you wanted to go on holiday, you could only take a certain amount of money with you, etc. Maggie abolished those in 1979 as the UK's balance of payments improved as a result of North Sea oil revenues. In addition, back in 1980, UK 10-year yields were 14.4%. So, because of inflation, so paying down the government debt actually resulted in returns comparable to investing in the stock market. And that's what she did. She paid down debt. So debt as a percentage of GDP fell from 43.2% of GDP in 1980 to 28.5% in 1990. So Maggie cannot be held responsible for the fact that future British governments were irresponsible and put the debt to GDP ratio back up to 100. And she also used the wealth from the North Sea to allow her to cut taxes. So, reminder, under the previous Labour government, the maximum rate of income tax had been 83% with a 15% surcharge for unearned income, i.e. 98%, which, as all of you will realise, would have produced zero net tax income because nobody is going to earn income where they get 2% out of £100, 2p out of £100. It's a totally idiotic and counterproductive policy. But
That was Dennis Healy, wasn't it?
yeah, um, and so all Britain's wealthy all fled to Switzerland or the States. So Maggie then cut income tax to 60% to a start, but then it's been, obviously reduced from there. And that, so North Sea oil revenues allowed her to cut income taxes without cutting expenditure and to reduce debt. So when we look at the debt to GDP ratio, it went from, what's that, like 50% in 46% in 1980 to a minimum of 23% in 1990. Bond yields came down as a function of getting inflation under control and fiscal responsibility, reducing the debt. You know, Rachel Reeves, you watching? So the return you can then get from buying UK government debt at 14.4% is comparable with investing in the stock market, but without the risk. And tax rates came down. So actually, I found his argument entirely convincing. Actually, so I'm not going to be saying we squandered our oil wealth anymore. I think actually the UK was under a great deal of pressure at the time, financial pressure at the time, and the oil revenues allowed Maggie basically to get rid of capital controls, which is a huge thing, and allowed London to re-emerge as a financial centre later in her premiership. And the money was used to pay down the debt. So, Richard, what are your thoughts?
Yeah, it's interesting, Keith. I, like you, would have said that it had. I mean, it had. In some sense, so it wasn't squandered by Maggie. It was squandered by future governments,
Yeah.
increasing the debt, government debt,
Yes.
so vastly. But that is interesting. I also, but of course, the point about paying back at a high level of interest, getting rid of that debt. So, of course, what we should be doing now is we shouldn't be importing or any oil we don't need to import. We should be producing our own. And we should not be pretending that we're being green by not producing our own.
Yeah.
And then we should be using that revenue, in my view, to create a wealth fund. And, the news at the moment, isn't it? Well, they're cutting back fundamental physics research, which actually leads to all sorts of technological developments and growth in the economy over many years, and we should be investing in that sort of thing. And we should be investing in actually monetizing those developments over the long term, which we do very badly in this country. So I'm slightly rambling here, but what I'm really saying is that we now need to have a complete change in our philosophy of government to invest in the country, not just to spend money.
Well, yeah, that basically what we've done is massively increase social welfare payments.
Yeah, and on the basis of it, killing the goose that laid the golden egg, and the goose is in intensive care at the moment. So I think we are on a very depressing path at the moment.
Yeah. So on to the EU, Richard.
Thank you, Keith. So EU interest rates still at 2.15%. CPI was down by minus 0.5% in January and up 1.7% for the year to date in January.
Yeah, I think that's largely energy prices, which have collapsed over the past year.
Yeah. Core CPI year on year 2.2% in January. PPI down 0.3% in January and down 2.1% year on year.
Yeah, that's good news. Input prices falling.
Yeah. And the EU GDP growth quarter on quarter was 0.3% in quarter four, 1.3% year on year. So pretty anemic there as well.
Yeah, on the input prices, I'm surprised because we're seeing, base metal prices going through the roof, rising quickly, but we're seeing
Yeah.
PPI being consistently zero or negative.
It may be that they've got their pricing secured for a few months and that we're going to see
Mm,
a surge in PPI coming through over the course of the next few months.
yeah.
So retail sales month on month down 0.5% in December and up 1.3% year on year. Unemployment rate 6.2%.
Yeah. All-time low.
Yeah, yeah. Loans to companies year on year was up 3% in December.
Decent.
Yeah, and loans to households also up 3% in December. Money supply year on year up 2.8%.
Yeah. Compatible with our 2% target.
And economic sentiment is at 99.4.
Actually improving.
Yeah. Construction PMI 45.3. Well, that's still in an uptrend.
Yeah, but that's, it's been below 50 for three
Yeah.
years now.
Inflation expectation 2.8%, so flat. And there's the economic surprise index. So the German indeed job postings 111.8 and started to fall off again. And France's postings 111, which is actually a bit better than last week.
Yeah, but again, that downtrend just looks intact.
Yeah. So the summary, have a read, is stagnation, little obvious sign of a pickup in economic growth.
Thank you, Richard. On to the US. So yesterday had non-farm payrolls. As we discussed, that was a big positive surprise, up 130,000. But when you look at the revisions for last year, it sort of undermines any confidence you might have in the non-farm payrolls number, really, because they downgraded it by a total of 1.023 million to just creating 181,000 jobs for the whole of 2025. So this is the net effect. Thank you for Ali Baroid for sending me this chart. But you know, how much confidence do you now have in our non-farm payrolls? Question mark. Goldman Sachs estimate that the underlying job creation in the US was around 55,000 in January, i.e., there has been a bit of a recovery. It's no longer deteriorating. So weak but stable is what they're saying. When we look at non-farm payrolls, frankly, it looks odd because almost all the job creation was in the health and social assistance sector. And if there's strength in hiring in the social healthcare and social assistance sector, wouldn't you see a pickup in job adverts in that sector? And there ain't none. It's been continuing to decline. So something looks odd, frankly. But the background is 2025 added only 181,000 jobs, which is the weakest year outside of recession since 2003. So the US economy is doing fine, but the labour market ain't. In part because one thing Trump has successfully done is cut the number of jobs in the federal government by about 10%, which is an astonishing number. You wonder what effect that's going to have on the effectiveness of government. And when you look at the household survey, it reported a rise of 528,000 jobs in January, which is good, almost all of them full time, which is excellent. And as a result of those revisions, down to non-farm payrolls and up to the household survey, you'll see the two series are back in line. Average weekly earnings are 0.4% month on month in January, 3.7% year on year. Still gradually coming down, I'd say. The unemployment rate ticked down to 4.3%, which is odd. It's consistent with non-farm payrolls, but as we'll see in a second, job openings have continued to decline. The U6 unemployment rate fell very sharply to 8.0%. Suspicious. Participation rate ticked up. It's good news. So here we are. The JOLTS job openings declined for the third month in a row to 6.5 million. Now, if job openings declining, how come employment is rising and unemployment is falling. There's some contradictory data there. And the JOLTS numbers show that hiring is weak, but as yet there's been no real pickup in layoffs. And what's noticeable is a big part of the fall in JOLTS job openings in January was in professional and business services. Is AI starting to have an accelerating effect? And according to the Beveridge curve, as job openings fall, so unemployment should rise. And so in January, we saw that the number of job openings fell, which should equate to a rising unemployment level rather than a falling one. Odd. And generally, all the data is showing that job openings continue to decline. The labour market is weakening, and that means there are now more workers than jobs, job openings. So wage inflation should continue to come down. The ADP said that there are 22,000 private jobs created in January, and the picture is of general weakness. Challenger job cuts, big leap, 108,000. So it takes about 2 months for those to show up in the unemployment numbers. So very mixed signals coming out of the US job market. And that was a big number for January, the Challenger job cuts. Small employers have been cutting jobs for months. Retail sales were weak in December at 0.0% month on month, 2.4% year on year. And the general backdrop also seems to be of increasing consumer weakness. We've shown you this chart many times over the past few years, but it continues to get worse. So delinquency rates on credit cards continue to rise, on student loans rising, auto loans rising. Poor US consumers are in trouble, and US consumers in general are drawing down their savings to fund consumption. That can't last forever. New York, I thought this was a really interesting chart. New York restaurant sales are falling again. Traffic has been falling for a while. The US consumer appears to be losing its mojo. But the US economy, driven by AI, is productivity is great. So, there's contradiction here in that, if the US economy is propped up by AI and AI capex, and then they're then cutting jobs to support earnings as they put all their money into AI investment, then the US economy will fall into a fallacy of composition whereby, all those workers laid out of jobs can no longer spend and support the economy. Let's see. Unit labor costs falling because of strong productivity growth. That's great news for businesses. And so the labor cost index was only 0.7% in Q4. Very good. ISM manufacturing showed a big bounce in January. Pause, have a read. New orders showed a big rise. So is there a cyclical upturn in manufacturing? The trucking freight index suggests there is, actually. That's been rising. Services, on the other hand, was flat, but that's an okay number, not great, but okay. New orders fell back a bit, which is not so good. Michigan consumer sentiment, still very poor. Logistics managers index, rising. That's good news. The small business in the US, going nowhere, sentiment, but okay. They are not participating in the capex surge. Small businesses have been cutting their investment. The economic index, the economic optimism index, which is a survey of US consumers, ticked up, but that's not a great number. Further signs of distress for US consumers in that total vehicle sales falling in January, well below expectations. Balance of trade, not great. Initial jobless claims picked up but stable. Continuing jobless claims, no signs of any concerns there. Job postings index appears to have stabilized. wage growth are falling. That's good news for inflation. Link up also corroborating the JOLTS number of job openings falling. Onto the nowcasts. Dallas Fed 2.7. Atlanta Fed 3.7. That's for Q4. And that's down from its ludicrously high earlier estimates. New York Fed nowcast 2.6%. That looks perfectly decent. Similarly, Fed 0.1%. That's for Q4. Not great. Economic surprise index positive. Trueflation is great. Really falling back. So inflation in the US appears to be really coming under control. And tariffs have stabilized about 30 billion a month at an effective rate of 12%. So that is raising money for the US government. So youth unemployment has been rising. So lots of graduates not doing so well, having trouble finding a job, and real graduate salaries have been falling. I returned to my comments about fads earlier. Severe student loan delinquencies have exploded to an all-time high. And Trump has been very bad for income inequality. The rich have got richer, the poor have got substantially poorer. But all those tariffs have been very good for the deficit, which is down in January. So January on January is down as an astonishing 26.4%. So, fiscal tightening. Bottom line, the US economy is doing just fine, supported by AI capex, but we're getting very contradictory signals out of the US labour market. To me, the summary would be weak but stable, question mark. Job openings continue to fall. And on to China. So Chinese inflation remains very weak, to 0.2% year on year. PPI still negative. Input prices negative. So manufacturing PMIs, all the PMIs from the National Bureau of Statistics were weak, suggesting a weakening economy. So both the services and manufacturing PMIs were at 49.3, suggesting the economy is slowing, general at 49.8. But then when we look at the private sector, rain dog, it's kind of going in the opposite direction. Manufacturing above 50, strengthening slightly. Services above 50, strengthening slightly. General above 50. So once again, contradictory data. What is true is that Chinese exports to the US have been weak, and for manufacturing sector, that's not great. So bottom line, once again, it's very difficult to know make anything out of China, frankly, because we don't trust the statistics and they're very contradictory. But still seems to be growing at 4.5% a year, if you believe the numbers. And we're going to wrap up there because we've had a lot to talk about and we'll probably overrun our time. So concluding comments, software stocks have fallen sharply on fears of AI disruption. And so the emphasis in the market has shifted from glee over the opportunities for AI to fears over its disruptive effects. So that's quite an important change. It's one from optimism to fear. Precious metals have also fallen sharply, particularly silver. Is that a pause in the bull market or the end of a bubble? Which and I have contradictory opinions on that. Industrial metals have seen a setback, but frankly, when you look at the charts, the uptrend seem intact. Nasdaq looks to me like it's topping out. Now, what have I done? Well, I sold almost all my copper miners. As we discussed earlier, this is the iShares and this is the Sprott Pure Play. You'll notice they've hardly come down. So, the market remains optimistic about copper. And I've been buying oil companies. Now, they've had a good run and I've been buying them at the end of that good run. So we'll see whether they fall back. But on Richard's point, medium term, I'm optimistic and I'm just going to live through the volatility. And, one of the things I've learned is to listen to the market, and the market is saying it's optimistic about oil. So medium term, I think I'll be all right. Short term, who knows? Harbour Energy is another one. Dividend yield 9%, best part of. Ithaca, these are all listed in the UK, yield 9.8%. And Serica, bought all of these. And that's it. So, lots to talk about. I've prepared actually a lot of sections which we didn't have to get time to get through. I owe you some sections on Japan and copper, which I'll now be back and working on. So hopefully back to a more normal episode next week if the markets let us. In the meantime, thank you very much for watching and your continued support. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.